Many organizations prepare an annual budget. Your role as an executive, owner, or director is to review the annual budget and approve it. So in this lesson, it's to prepare you to fulfill that duty. Let us begin by understanding why we budget and how a budget comes together. Let's start first with the why. Budgets have many uses in business, and some of these uses actually conflict. So budgets get used to, first of all, set the expectation for banks and shareholders about the rate of return. Often, this version of the budget tends to be more conservative because there's nothing more damaging to credibility than missing your numbers. We may also use a budget, however, to set the target for senior, middle management, and employees to achieve. Often this version of the budget has an incentive to set it a little bit more aggressively to keep people sharp and force them to focus more. However, it can't be too aggressive and it can't be too sharp because it may lose credibility or belief in its achievability. Next, the budget helps managers allocate and coordinate resources. The preparation and review of the budget structures a cross-functional conversation that helps the sales and production functions align, and then the supporting functions and staff accordingly. The budget also helps measure and monitor performance throughout the period and helps identify when things are going better or worse than planned, which allows for management to make adjustments. And finally, the budget provides a future financial perspective of performance. It helps with cash flow management, it helps with funding requirements. These all sound like really good objectives. However, herein lies some of the challenges that you will be confronted with as you go about deciding on where to set the budget for next year. First of all, the aforementioned conflict between setting budgets that are neither more or less than conservative to serve different purposes. This can cause different versions of the budget or set unrealistically high or low targets which may erode the effectiveness of this tool. Budgets are often prepared months in advance of the coming year. Planning a year or more in advance can be very challenging, and oftentimes budgets quickly become irrelevant in a dynamic business or a dynamic business environment. And then finally, budgets tend to align with fiscal years. Thus, as the year progresses along, the visibility to the end of the year gets shorter and shorter and shorter until the next fiscal year's budget gets approved. So how does a business address these sorts of budgeting challenges? Forecasting is a term that you can use when you're looking at any financial forecast that is not a budget. It's often just an update of the budget assumptions for any new or better information. Forecasts can be updated anytime, monthly, quarterly, or only after the budget assumptions lose their validity. When things start unfolding differently than the budget, often executives, owners, and/or directors will request of management a revised forecast. This can be done as frequently as needed to get a sense of the future. Some businesses, in fact, have adopted a rolling forecast to overcome some of the challenges of traditional budgeting. A rolling forecast maintains a 12-month time horizon and gets updated continuously. So now let's address the hows of budgeting. There are two main approaches that management may take to doing and preparing their budget. The traditional approach takes last year's results and then adjusts them for any changes in sales and operations for the upcoming year. For example, management may target several new customers and factor those into the sales budget, with the balance of the business expected to be very similar to the previous year. Production then updates the standard costs to arrive at a target margin, and each department determines whether more or less resources are required to support the new business. One-time items that hit last year's numbers also get normalized and adjusted in or out. This is generally a more efficient but less precise approach to preparing a budget. The second approach is to use what is called zero-based budgeting, and this takes nothing for granted. Sales are built up by product line and customer. Cost of sales are built up by using the BOMs and creating a production schedule. Operating expenses are budgeted on a line-by-line basis for all labor and non-labor expense accounts. This approach is time-consuming, but it's most helpful when costs need to be cut and there is a concern about who is accountable for which expense. Ask management which approach they have used to prepare the budget, presented to get a better sense of the precision of the budget assumptions. The budgeting cycle involves all departments across the entire organization. It begins at the middle management level, it gets aggregated by finance, and then reviewed and approved by the senior management level before being presented to the executives, the owners, or the board of directors for approval. Finance is often the leader and coordinator of the budget process. However, bear in mind that the budget should not be owned by finance. Finance is a messenger. The owners of the budget are the various departments individually and senior management collectively. The phases of the budgeting cycle typically follow this sort of a process. Sales prepares a detailed forecast by period for the coming year. This will include customers, channels, and products. This information must be budgeted on an activity basis, i.e. when products are expected to be delivered, not when cash changes hands. The supply chain will come up with a distribution plan and the inventory requirement, which will be sent over to production, and production team will come up with a production and procurement plan to schedule and cost the acquisition of inventory. Then the supporting functions will all submit their labor and non-labor overheads for the year. Capital budgets will be prepared for all the maintenance and growth CapEx spending. And then finally, finance will aggregate all of this information, prepare the budget, and add in any corporate or financing costs. The operating budget is a budgeted income statement following GAAP conventions. The cash budget translates the operating budget into cash flow. In fact, a best practice in budgeting is to include the balance sheet with the budgeted income statement and cash flow statement to give a fulsome perspective of the expected financial performance of the operations, as we have learned about when we were reading the financial statements. Now, many organizations overlook budgeting the balance sheet and cash flow statement, and as a result, only budget half the story. Once that budget is set, it should be locked in stone. We like this quote, "The budget is the budget, do not budget." It's catchy, it's memorable, and I've used it many times since. This helps people stop iterating on the budget and trying to perfect their prediction of the coming year. The budget is merely a target at a point in time. After the year gets rolling, resist the temptation to revisit your budget and instead incorporate that into a forecasting process to allow managers and executives and owners and directors to iterate different views of the future. So that's all we're going to cover in this course on management accounting. In our next lesson, we're going to start diving into finance. We'll see you there.